The ultimate nightmare for any commercial real estate investor is sinking capital into a project that becomes a vacant, tenantless ghost mall. To solve this specific vacancy risk, developers are increasingly abandoning the traditional retail format. Omaxe Dwarka Sector 19B is testing a different strategy: extreme scale and mixed-use design. Spread across more than 50 acres, this project is structured as a massive 5-in-1 destination. The blueprint integrates high street retail, food courts, a multiplex cinema, a hospitality club, and a massive sports complex. By building a self-sustaining ecosystem with multiple reasons to visit, the developer is using variety as an insurance policy against commercial failure. This strategy is backed by a specific structural advantage. The project is being developed under a PPP, or public-private partnership model, in direct coordination with the Delhi Development Authority. While neighboring markets like Gurgaon are saturated with commercial spaces, this development secures a rare premium footprint inside Delhi itself. It sits directly near major transit hubs, located roughly 15 to 20 minutes from the Indira Gandhi International Airport. It is also positioned right on the Dwarka Expressway, a signal-free corridor designed to handle heavy, seamless daily traffic flow. The developer is currently marketing this project with a highly accessible barrier to entry, advertising units starting at just 40 lakh rupees. While the 40 lakh entry price secures a spot in a DDA-backed Delhi project, commercial real estate operates on strict capital hierarchies. The lowest entry point often carries the highest hidden risks. A 30,000-seat international cricket and football stadium serves as the anchor for this 50-acre development. This physical stadium is supplemented by a dedicated 75,000-square-foot esports arena. The logic behind these massive venues is that matches, conventions, and digital tournaments guarantee heavy surges of people at predictable times. This chart compares two distinct footfall trends. The flat, steady line represents the daily traffic of a standard mall, while the line with massive, sharp peaks shows the projected traffic for Omaxe Dwarka on event days. A standard apparel or electronics store relies on a steady daily conversion rate to survive. The low valleys between event days represent significant risk zones for traditional retail storefronts. Conversely, the 40-plus cafes and restaurants planned for the space are optimized for those sharp peaks. They will thrive on the massive post-game crowd surges. Sports-anchored footfall is highly effective at bringing bodies to the property, but it heavily favors hospitality and food service investors over standard retail operators. To incentivize buyers, the developer offers 10 to 12% assured returns and flexible payment plans. This effectively neutralizes the primary risk of buying under construction real estate. You get paid a yield while the cement is still drying. This timeline graphic illustrates exactly how that financial incentive works. The solid, guaranteed income block during the construction phase terminates at the vertical line marked possession date. The day after you take physical possession of the unit, the developer's safety net vanishes. The timeline extends into an unpredictable, fluctuating dashed line labeled market-dependent rental yield. At this point, your actual return on investment relies entirely on whether your unit can secure a lease tie-up with a paying brand. Assured returns protect your capital while the project is being built. They do absolutely nothing to guarantee your long-term rental income once the doors open. Securing a brand lease post-possession comes down to one single factor: how much capital you deploy. This pyramid represents the project's investment tiers. The wide base at the bottom shows the heavily marketed entry-level options, starting at 40 lakh rupees. That 40 lakh tier buys a piece of the property, but restricts you to the least desirable locations: higher floors, back corridors, and low visibility zones. Moving up, the middle tier highlights the 50 to 75 lakh segment. This is currently the most demanded tier for retail units. Investors target this bracket because it provides enough capital to secure units optimized for those highly profitable food and beverage setups. At the very peak of the pyramid, we find the 2 crore to 5 crore plus premium investment bracket. These investors secure portions of the project's 4.2 kilometers of massive retail frontage. That ground floor visibility practically ensures immediate, high-paying brand leases. Lower capital investment drastically increases the time and difficulty required to secure a reliable tenant. This chart maps required capital against the probability of high rental yield. The 2 to 5 crore buyer lands firmly in the top right quadrant, a highly secure, low-effort play. The 70 to 80 lakh investor drops into the middle, targeting the stadium's event-driven crowd. Finally, the 40 lakh buyer lands in the bottom left. The entry price is tempting, but immediate tenant acquisition is low. The project's overall structural success will not guarantee every individual investor's success equally. Omaxe Dwarka is a mechanically sound project that holds a deep geographical advantage inside Delhi. But a 50-acre mixed-use mega-hub demands a cold, analytical approach to capital placement, rather than emotional buying triggered by low entry prices. Success in commercial real estate depends on buying visibility alongside square footage. Those entering at the base tier must budget for this reality and prepare for a long vacancy horizon.